Numbers rarely stir emotion in Philippine banking, yet sometimes they demand attention. EastWest Banking Corporation, under the Gotianuns family stewardship, is telling just such a story. Between 2022 and 2026, its regular cash dividend surged from 0.40 to 0.82 pesos per share, a compound annual growth rate near 20%. Not a fleeting spike, but a four-year pattern. What compels such growth? And does it truly rest on solid ground? The evidence points to thoughtful discipline. In 2022, EastWest paid a modest 0.40 pesos per share, about 900 million pesos in total, while net income reached 4.6 billion pesos. A cautious payout, shaped by uncertainties after the pandemic and rising rates. By 2023, net income climbed 32% to 6.1 billion pesos, yet dividends edged up only marginally. Management signaled that profits would be proven before distribution, a lesson in prudence. Momentum shifted in 2024 and 2025. Dividends jumped to 0.54 and then to 0.68 pesos per share. Total cash payouts followed, rising more than 65% over 2 years. Still, scrutiny was warranted. Did fundamentals genuinely justify this acceleration? The 2025 annual report offers reassurance. Earnings growth stayed robust, with net income reaching 9.22 billion pesos, up 21% from the prior year, more than doubling 2022 figures. Net interest income expanded, fueled by a healthy 13% rise in loans and receivables, driven by consumer lending. Profitability ratios improved steadily. Return on equity reached 11.9%. Net interest margin widened to 8.5%. Crucially, the payout ratio remained conservative at just 17%, with the board's target comfortably higher. Dividend growth trailed earnings growth, not the reverse. The balance sheet underpins these payouts. Equity rose to 81.5 billion pesos, with retained earnings growing despite dividend distributions. Capital adequacy and Tier 1 ratios remain well above regulatory minima, offering safeguards for sustained growth. Risks linger. Provision for credit loss jumped to 14.2 billion pesos, up 48%. Management attributes this to loan volume and portfolio maturity. While earnings absorb the impact now, future increases in credit costs may temper dividend growth. But the story remains clear. EastWest's dividends reflect compounding discipline, not bravado. The growth is supported by genuine improvements in earnings and capital, matched by prudent payout decisions. For income-focused investors, the numbers signal reliable performance, quiet compounding, built not on promises, but on sturdily growing fundamentals.